The Fed has been cutting interest rates continuously for the last 15 months, but there are still a lot of misconceptions about what that actually means for our economy. How long does it take for Fed rate cuts or rate hikes to impact our economy? What is the main mechanism by which rate cuts or rate hikes ultimately impact economic activity? That's what we're going to clear up, and we're going to answer those questions in this video, and we'll get to the bottom of what do the Fed's rate cuts actually mean for our economy. So, as I mentioned, the Fed has been very, very busy cutting rates. In fact, over the last 15 months, we've had 175 basis points worth of cuts. That is very, very aggressive. It started last fall in September with 50 basis points, and since then we've had a bunch of smaller 25 basis point cuts. The main thing to realize is that interest rates affect the economy with a long lag. We like to say generally around 18 months. And when we walk through this diagram, it will make a lot of sense why there is a delay between a change in rates and its full impact on economic activity. Now, spoiler alert, the main mechanism by which interest rates affect the economy is via housing. And you'll see that in this graphic here. So let's start in the top left here. Interest rates decline. What do people do? They start looking for homes, right? Mortgages, hypothetically, are now cheaper. Your monthly interest rate will be lower. So they log on to here, Zillow most likely, and they'll find a realtor. They'll start to go look at houses. Eventually, they'll see some houses that they like. They will make an offer. Hopefully, it gets accepted. They then have to go get a mortgage. A lot of stuff happens. They close on their house, and eventually they move into their new home. They have to hire movers. They have to buy furniture. So when interest rates fall, it's not just the next day people are going out and buying homes. A lot of things need to happen, and that helps to explain why there is generally an 18-month delay between changes in interest rates and changes in economic activity. So now, the impact of a change in rates on economic activity is magnified due to the long list of expenses associated with the purchase of a new home. So home buyers spend a lot more than non-home buyers in a given year. So, as we've mentioned, the U.S. consumer accounts for 70% of U.S. GDP. I think I've said that in almost all of the videos I've made at this channel thus far. And so when interest rates change, we see changes in consumer behavior via the purchase of new homes. And here we can outline the difference between what a home buyer spends on appliances, furniture, repairs, and alterations versus what someone who's not moving spends. And the difference is an extra $5,000 a year. So when interest rates are falling and more households are buying homes, we would see those people spending $5,000 extra dollars, putting those dollars to work in the economy versus someone who was not moving. That can have a big impact when you have a bunch of people moving at once as interest rates fall. So what happens? There are many factors that help amplify the effects of the purchase of a home on labor markets and the economy. So what is the flow through to labor markets? Well, as you can see in the chart here on the right, home builder sentiment actually leads labor markets. Here we have it with about 15 months. Then we have another diagram here on the left that will show why. Okay, so as home builder sentiment improves, you see increased housing activity. You see an increase in consumer confidence, and home prices start to rise. Now, we already talked about the mortgage side. As more and more people are looking to buy homes because interest rates have made getting a mortgage a bit cheaper, what happens? The demand for houses increases, home prices rise. So besides the extra spending that you get via people moving, having to buy furniture and appliances that we talked about on the last slide, you also see an increase in retail spending given the wealth effect. So when people are looking, even if you're not changing homes and you're looking at your net worth, and you see that because of the increased demand of new home buyers, your house is now worth more than it was previously, you feel wealthier. The same way when the stock market is soaring, people look at their 401ks and they're at all-time highs, people feel wealthier. So what do? They go out and they spend more money. So when home prices rise, generally retail spending tends to pick up 6 months after we start to see a rise in home prices. And what do we see when we see an increase in retail spending? Well, we need people to service that demand for new spending. We see hiring. So housing is the main mechanism by which we see interest rates flow through to economic activity. Now, let's bring this all together. So, the Fed's fund rate is where it all starts. Monetary policy is at the heart of every US cycle in recent memory, whether that's a recovery or a slowdown. This makes it a key ingredient of any macroeconomic forecasting model or framework. So, what do we have here in this chart? We have the federal funds rate in red leading the ISM New Orders Index. Now, if you've paid attention to our content before, you will know the ISM New Orders Index is one of our favorite leading economic indicators. So yes, the Fed's fund rate leads leading economic indicators. So changes in the Fed's fund rate lead LEIs by about 18 months. So that's what we talked about, where interest rates eventually impact economic activity. This is showing it graphically. So again, the 18 months that we talked about, you can see that historically this relationship is great outside of ZIRP. Obviously, when the Fed was not changing interest rates, they were keeping them at the zero lower bound. This relationship did not hold up, right? There was still economic activity despite the fact that the Fed funds rate was pinned at zero. Now, the Fed's funds rate and other yields tend to trend together. So interest rates are usually correlated across maturities. So different versions of rates can be used interchangeably for forecasting purposes since they generally trend in the same direction. So you don't need to use the federal funds rate, right? So these interest rates will fluctuate, as you can see from this line. The further you get out on the yield curve, so the longer term maturities, they are less correlated with the federal funds rate. But generally speaking, when you're looking to forecast, you can use interest rates interchangeably. Now, some interest rates will have better relationships with different series, so that's why you'll see different interest rates used throughout our work. But generally speaking, right, this held up even during ZIRP. When the federal funds rate was pinned at zero, you still have economic forces that are moving interest rates. So why does this matter? What is the goal? Well, the goal of all of this, of macro forecasting, is to find where you are in the cycle and make investment decisions based on that information. That is a very simplified version of what we're trying to do, but for the purposes of this YouTube video, that is a perfect description. So, as we talked about, interest rates in all forms, whether that be the federal funds rate, treasury rates, will have some leading properties on LEIs. LEIs are a proxy of economic growth, and that is exactly what the business cycle is. We have it here in this red box. The business cycle is the natural rise and fall of economic growth over time. So if you know what LEIs are doing, or if you have a sense of what LEIs are going to be doing in the future, you can get a general sense of where you're at in the business cycle. So are LEIs recovering or are LEIs expanding? You could be in an expansionary part of the business cycle. Are LEIs starting to slow, or do you anticipate that they will be slowing based on the actions of interest rates 18 months prior, 12 months prior, etc.? We might be entering a recession, or a TRO might be in a contractionary phase. So interest rates are the most important predictor of leading economic activity, like PMIs, and more specifically, the ISM New Orders Index. So when we see the flow through to economic activity, we talked about economic growth. The ISM New Orders Index is an LEI, and all LEIs are leading indicators of the same thing, which is the economy. So here you can see in the chart, the ISM New Orders Index in blue is advanced 6 months on US GDP. And then we bring it together. The 10-year treasury yield here is advanced 18 months on the ISM New Orders Index. So the ISM New Orders Index leads GDP by about 6 months, and the 10-year Treasury yield leads the ISM New Orders Index by about 18 months. So put that together, and you see a flow through from changes in rates to GDP with a 24-month lead time. So sometimes when you have politicians pressuring the Fed to change interest rates, I think a less understood thing is how long it actually takes for changes in interest rates to flow through to GDP numbers or economic growth indicators like the ISM New Orders Index. Now, this was just a small portion of what we talk about when it comes to macro forecasting. Again, this was not even an appetizer. This was just the chef's snack that he gives as you're sitting down at the table. We go into way more depth on these topics and how you can make investment decisions based on this information. Once you figure out where you're at in the cycle, what are the decisions that then follow from there? We have two options for how you can learn this. The first is our full macro specialist designation program. That is option one. That is, think about the CFA. They teach bottom up. We teach top down. It is a similar designation program. Option two is our macro investing bootcamp. That is a 15-hour self-paced, fully online investing bootcamp where we walk you through the basics of the macro specialist designation. And then if you would like to continue on to the full program, what you spend to join the bootcamp counts as a credit against your full enrollment. So I have a QR code here. Take a second, scan it, and you can learn more about these programs. If you're interested in taking your investment knowledge to another level, I highly suggest you check out one of these options. We've had a lot of investors take these courses. We've had fantastic feedback. It's truly something that is not out there right now. And that's what I'm going to leave you here today. I hope you enjoyed the video. I hope you learned something. If you did, don't forget to subscribe to the channel, and I will see you next week with another educational video.